The role of central banks in Forex trading for intermediate traders. Introduction. Central banks play a crucial role in the foreign exchange market, influencing exchange rates, monetary policies, and overall economic stability. For intermediate Forex traders, understanding the role of central banks is essential as their decisions and actions can have significant impacts on currency values and trading strategies. In this text, we will explore the role of central banks in Forex trading, focusing on their objectives, tools, and how traders can effectively analyze central bank actions to make informed trading decisions. Objectives of central banks. Central banks are responsible for managing a country's monetary policy and maintaining economic stability. Their main objectives typically include price stability. Central banks aim to control inflation and stabilize prices to foster a conducive economic environment. Economic growth. Promoting sustainable economic growth and employment are crucial aspects of central bank mandates. Currency stability. Central banks strive to maintain stable exchange rates to support international trade and investment. Tools used by central banks. Central banks utilize various monetary policy tools to achieve their objectives. Interest rates. One of the most powerful tools, central banks set benchmark interest rates that influence borrowing costs, consumer spending, and investment. Open market operations. Central banks buy or sell government securities in the open market to influence money supply and interest rates. Reserve requirements. Central banks establish the minimum reserves banks must hold, affecting the amount of money banks can lend. Forward guidance. Central banks provide guidance on their future policy intentions, which can impact market expectations and influence currency values. Impact of central bank decisions on Forex trading. Central bank decisions and announcements can cause significant market volatility and impact Forex trading in the following ways. Interest rate decisions. Changes in interest rates directly affect currency values. Higher interest rates generally strengthen a currency, while lower rates may weaken it. Policy statements. Central bank statements, press conferences, and reports provide insights into the bank's future policy direction, influencing market sentiment and currency prices. Quantitative easing, QE. When central banks implement QE programs, injecting money into the economy, it can lead to currency depreciation. Currency intervention. Central banks may intervene in the Forex market to stabilize or influence their currency's value against other currencies. Analyzing central bank actions. Economic data. Keep track of economic indicators and data releases that may influence central bank decisions, such as inflation rates, GDP growth, and employment data. Monetary policy statements. Pay close attention to central bank communications, including policy statements and minutes of meetings, to understand their outlook and intentions. Forward guidance. Analyze central bank guidance on future policy decisions to anticipate potential shifts in interest rates or monetary policies. Sentiment analysis. Monitor market sentiment and positioning around key central bank events to gauge potential market reactions. Risk management. Central bank actions can lead to increased market volatility and sudden price movements. Implement effective risk management strategies, including setting appropriate stop-loss levels to protect against adverse market fluctuations. Conclusion. Understanding the role of central banks in Forex trading is crucial for intermediate traders seeking to navigate the dynamic and often unpredictable Forex market. Central banks' decisions, such as interest rate changes, quantitative easing, and policy statements, can significantly impact currency values and market sentiment. By analyzing economic data, studying central bank communications, and monitoring market sentiment, traders can make more informed trading decisions and better manage risks. Keeping a close eye on central bank actions allows intermediate traders to adapt their strategies and seize potential trading opportunities while navigating the complexities of the Forex market.